Legacy automakers have been making bold promises regarding their surge in battery electric vehicle production and sales. However, the results so far seem to have had little impact on this rapidly evolving landscape. While there have been noticeable spikes in sales when compared to the previous year, the prominent force in the industry, Tesla, continues to maintain its position as the dominant seller of electric vehicles. In fact, not only has Tesla retained its lead, but it has also expanded the gap between itself and traditional automakers. As we analyze the numbers, it becomes clear that Tesla is nearly 300,000 units ahead of its closest competitors, Hyundai Motor and General Motors, in the first half of this year, as reported by Motor Intelligence. This significant disparity has widened compared to the roughly 225,000 gap observed in the same period of 2022. Join us as we delve into a concerning trend that has caught the attention of the electric vehicle market. During Hyundai's recent Investor Day held in Seoul on June 20th, the Korean automaker reaffirmed its dedicated shift towards electric vehicles (EVs) as an integral part of its strategic vision, referred to as the Hyundai Motor Way. This forward-looking blueprint for the company's future involves a substantial investment of 109.4 trillion won, equivalent to $85.41 billion over the coming decade, with a significant portion, approximately 35.8 trillion won, $27.8 billion, allocated specifically for the advancement of electrification. As part of this comprehensive strategy, Hyundai has set an ambitious target of selling 2 million EVs by the close of the decade, reflecting an impressive 7% surge from its current sales levels. A key focal point of achieving this objective lies in boosting sales across Europe and the United States. It's worth noting that Hyundai is concurrently navigating ongoing scrutiny in these markets, notably relating to its Ioniq 5 model, indicating the importance of addressing such challenges in its pursuit of EV leadership. According to the latest registration data, the first 3 months of 2023 have showcased a remarkable surge in electric vehicle EV sales. Impressively, a total of 257,507 battery electric vehicles were registered nationwide, reflecting an astonishing 63% upswing when contrasted with the corresponding period of the prior year. This trend underscores the escalating preference for environmentally conscious and economically efficient electric automobiles among consumers. Notably, the electric vehicle sector's influence on the overall market is becoming increasingly evident. The initial quarter of 2023 witnessed electric cars claiming a larger segment of the total car market, constituting approximately 10% of the entire industry. This notable advancement signifies a substantial leap from the 7.6% share observed in the first quarter of 2022. In the realm of electric vehicles (EVs), trends have shifted, with popular brands like Ford, Kia, Hyundai, and Lucid, which enjoyed strong sales in the past year, now facing a decline in their sales momentum. Interestingly, Tesla stands out as the dominant force in the market, accounting for 6 out of every 10 EVs sold in the country. This phenomenon becomes even more evident when reviewing the recent registration data encompassing 25 brands, where some entrants like Cadillac and Porsche are finding themselves closer to the bottom of the list. While EVs have made strides in terms of market share, industry analysts predict challenging times ahead. This hesitancy among consumers can be attributed to multiple factors, including the relatively higher priced and interest rates associated with EVs. Another significant aspect contributing to this trend is the substantial quality issues faced by both Ford and Hyundai over the past year. Particularly, Ford encountered notable quality challenges in 2022, leading the pack in recalls among all manufacturers with a total of 67 recalls affecting over 8.7 million vehicles. This extensive recall scenario likely eroded consumer trust and confidence in the brand. Additionally, Ford's much-anticipated F-150 Lightning production faced interruptions due to fire-related issues, further complicating the company's situation. Acknowledging these setbacks, Ford CEO Jim Farley stressed the long and continuous effort required to improve quality, signaling that it may take several years to address these concerns fully. In such a scenario, consumer perceptions of brand quality play a significant role in shaping their purchasing decisions. The presence of quality issues can erode confidence in a product's reliability and safety, leading consumers to explore alternatives in the market. Consequently, it's not surprising that these quality concerns have likely influenced consumers' diminishing interest in Ford vehicles, ultimately manifesting in the sales figures. According to CNN, Ford has projected a $3 billion loss in its electric vehicle (EV) sales to consumers for this year. However, the company maintains its confidence in achieving its profit targets of $9 billion to $11 billion for the year, even before factoring in expenses related to interest and taxes. This projected $3 billion loss closely mirrors the combined losses Ford incurred from EVs over the last 2 years. In 2021, the loss amounted to around $900 million, and it escalated to $2.1 billion in 2022. This marks the first time the company has provided a breakdown of its EV operation results. Ford anticipates a shift toward profitability for its EVs in the near future. The company aims to transition from a 40% operating loss margin experienced last year, where it sold approximately 96,000 EVs, generating $5.3 billion in revenue, to an estimated 8% profit margin by the close of 2026. This transformation is expected to coincide with the heightened EV production, potentially reaching an annual global output of 2 billion vehicles by the end of that year. Nevertheless, even if Ford attains its EV profit margin goals, its profitability is projected to be notably lower than that of the EV frontrunner Tesla. In the fourth quarter, Tesla reported a remarkable 22% profit margin, disregarding interest and tax expenses, along with depreciation and repayment costs. Although not a direct comparison to traditional automakers' profit margins, this underscores Tesla's substantial lead in profitability selling EVs while established automakers grapple with generating profits from electric cars. When queried during a recent investor conference call regarding Ford's potential to achieve its EV profit objectives, John Lawler, Ford's CFO, expressed confidence in the company's projection. Lawler attributed this assurance in part to the influx of talent from Tesla that Ford has managed to attract. However, it's important to highlight that Ford's growth rate lagged behind the impressive 68% expansion witnessed in the overall EV market this year. This figure also marked a significant decline compared to its own remarkable growth rate of 120% in 2022, as outlined by Experian. In terms of market presence, Ford's share of the EV market during the January to May period slipped from 6.5% in the prior year to 5%. Hyundai, which produces its EVs in Korea, became ineligible for the tax incentive, likely impacting its market standing and sales performance. To counter this, Hyundai proactively extended lease offers to customers, integrating a $7,500 EV discount within the lease terms, leveraging a tax regulation loophole. Automotive finance companies could claim the EV credit and then pass on the benefit to customers. Even while facing present obstacles, the rising market presence of EVs signifies a promising transition toward more sustainable transportation solutions. As car manufacturers refine their products and cater to evolving consumer needs, the electric vehicle sector is set to flourish and advance in the foreseeable future. So what do you think about this? Will Hyundai and Ford be able to overtake Tesla in the near future? Let us know in the comments section below. And if you like this video, be sure to like it and subscribe to our channel for more exciting news like this.